This is Life Insurance Awareness Month. We thought we would talk about the basics about the various types of life insurance. So there are basically two types of life insurance that are out there, and that's term life and cash value life insurance. And term life is considered to be temporary because it ends at some point. So, what happens in most term policies, term life insurance um, has an ending point and it does not end necessarily when you pass away. It could end when the time or the term is up. So when the term ends, then the policy ends. You can renew it, however, and typically it can be renewed without any health checkup or anything like that, but it does cost you more. And we'll talk a little bit more about term insurance in a few minutes. And then there's cash value life insurance. Cash value life insurance is considered permanent protection because it typically does not end. So, like the term policy, unlike the term policy, the cash value life policies do not have a term limit that it is up. Well, I'll say that it lasts a lifetime. They have stretched it out now to some cash value life insurance ending at 120 years old. It used to end at a lot of it used to end at age 100. I had um, actually two clients that their cash value life insurance policy at age 100, they would pay you back all the premiums that you paid into your policy, all the years that you had it. And I've had two clients that received all of their, they reached 100. One of them lived to be 103. The other one lived to be 102. But their cash value life insurance policy gave them back all of their money when they turned 100. But most cash value life insurance now, because people are living longer, they have moved that age up to 120 years old. So let's talk about term life insurance. Term life insurance can be written um, on periods as short as 1 year to as many as 35 years. I think it's a couple of companies out there that will do a term policy for 40 years. But the most that I've ever written or had the ability to write was 35 years. So term life insurance, the periods can go as short as 1 year and go as long as 35 years. It's been my experience. The ART is what is called an annual renewable term policy. And it lasts for 1 year and then it renews every year and the premium increases. So that is a 1 year term that will, you can renew every year and it will go up every year in price because you get older each year. So there are some people out there that will write and use the annual renewable term if they just need a term policy or they need protection for a short period of time, and they can maximize their money by getting a annual renewable term and have the protection in place that they need for that period. So there are other terms out there as well. So many employers offer term coverage to their employees, and more often than not, it's typically a group term that is renewable every 5 years. And so a lot of people get on the job, they get the protection on the job, and it is a term policy. It is a term policy that lasts, well, it'll last the whole time you're employed, but a lot of them are what's called the increasing term, or a group term policy that's increasing. And every 5 years, the premium will go up. So every 5 years, you'll be 5 years older and it'll cost more. However, because it is a group term policy, it is very inexpensive. So I encourage everyone when you're on the job to definitely maximize the coverage that they give you at work, because it's a group policy and they use the whole group to do the rates. It is very, very inexpensive. So I encourage you people to always take the insurance that your employer gives, because it's always going to be cheap. It's always going to be group term, and it's always going to be very inexpensive. However, that should not be the only protection you have. You should always have protection outside of the job, because once you leave that job, you are out of that group term policy. And if you are health wise uninsurable, you also lose this insurance that's on the job. You do not get to take this group term with you when you leave the job for in most cases. So there is your regular term, which lasts from whatever the term period is, anywhere from 1 year to um, 35 years. Then you have your ART, which is a 1 year renewable, and then you have your group term. So there's a variety of term insurance out there, and it has a lot of options and features that you can use and maximize with the term policy. You also, before I jump into cash value, you also can use that term policy. And the beauty of it is with us is we write a lot of term that has living benefits with it as well. So the term that we offer has living benefits, and there are a lot of companies out there that do not offer term insurance with living benefits. So that is term insurance kind of in a nutshell. There's, like I told you, there's two types of life insurance out there: term life insurance and cash value. So that was kind of a little overview on term insurance. And term insurance is not bad. It gets a bad name in the industry or rep in the industry, but it has its purpose, and it can meet your need and serve its purpose um, if you are educated on it and how term insurance works. Now, cash value life insurance is the other type of insurance. I told you in the beginning that there are only two types of life insurance. Now, cash value life insurance goes by several different names, and that is whole life, universal life, or I know one I forgot now that I'm here. Variable universal life is what I forgot to put on here. Index universal life, final expense, interest sensitive whole life. There are various names that cash value life insurance goes by. However, most of them work and operate pretty much the same. There are little differences in each policy, but the overall premises of the cash value policy is they pretty much work the same. So cash value, typically the cash value has a component. So part of the premium is going towards the protection, and the other part goes towards building your cash value in the policy. That is why they call it cash value life insurance, because it is building up cash value. So each one of those that I named has a way that they build up cash value. The interest rate in some of them are different, and it may fluctuate and go back and forth, but um, the opportunity to grow cash in each one of those policies is there. All of those policies, those cash value life insurance policies, also wear the name of permanent insurance. The reason they call them permanent insurance is because they do not end, like I said earlier, like your term insurance goes for a certain period. They will typically go for a lifetime. And then with the cash value life insurance, the similarities that all of those policies have that I named just a moment ago is you can typically borrow from the cash value. So as your cash value begins to accumulate in those type policies, then you can have access to the money in that policy and borrow against that cash value and use that cash value that is being built up in that policy if you need money out of that policy for whatever reason. Now, there's also opportunities with cash value policies when it is structured the right way and written the right way. You can grow your money and save for retirement in those cash value policies as well. So the cash value policy offers a lot of variables, a lot of opportunity for you to grow that money and use the cash value that is in the policy. A lot of people like cash value and they are somewhat knowledgeable of cash value only because of the first thing I listed there. They get an opportunity to borrow from the cash value. That's what most people tell you. Well, is this a policy I can borrow from? And that's all they want to know. But it's more typically more to the policy than just being able to borrow the cash. You also have the death benefit if something were to happen and you passed away. There's still the death benefit. You have the cash that is accumulating in the policy, and you of course can borrow from that cash. And then you also have some other. Wow. Okay. Uh, you also can get some of them when they're structured properly. You can also get a tax-free retirement income from the policy and get money from this policy at retirement. So if you save in these cash value vehicles and you save your money in the policy and it is structured correctly, as that cash value builds up and it grows, and you're putting in enough money to use it like a savings account as well, your money can grow. And if you don't pass away or don't have to use your living benefits because the policies we write with the companies at OIC 10K that we write, they have living benefits as well. We touched briefly on living benefits last week, but living benefits will help you with uh, critical illness, critical injury, chronic illness, terminal illness, and then a couple of the companies that well, one of the companies you write for even includes Alzheimer's in those living benefits. So if none of those things happen and you don't pass away, then your money can build up and you can have access to it tax free at retirement and use it for a retirement income. So there are a lot of opportunities with the cash value life insurance policy. You just have to understand how they work. And then you can also have paid up life insurance as well with the cash value life insurance. Many people are not aware of paid up life insurance and they've never had a policy the structure or design where it can be paid up. But we write policies that are paid up so that you don't have to pay, just like that first one I listed, for your whole life. That is one of the things about the cash value whole life policies. Typically, they are structured and designed where people pay for their, just like the name, whole life. So you have to look at the different cash value products that are out there and really understand how they work and see what works for you, what works for your situation. That is why it is important to sit down with an agent that is knowledgeable on these products and how they work and can look at your whole situation with that, like we talked about last week, the financial needs analysis that helps you go over your finances and look at your finances and look at your situation and not just put you in a cookie cutter product that they put everybody in. See, one of the things about life insurance, both term life insurance and cash value life insurance, is if that product is the only product that a agent can sell, then guess what? That's the only product they're going to offer you. And that's the one that fits for you when you sit down with them. It fits for you because it's the only one that they can offer. So you have to be careful when you're talking to agents and make sure that they are well rounded and can offer you, at least offer, they have the ability to offer an array of products because you don't want somebody to only put you in a product because that's all they can sell. So this is the difference between term life insurance and cash value life insurance. And we just touched bases on it. Just keep in mind, remember, two basic types of life insurance. Whenever you're talking to somebody about life insurance or somebody approaches you, it's real simple. You just want to know if it's a cash value policy or if it's a term policy. And then you can start from there. And then once they tell you what they're talking about, then you want to see which one fits for you. And your cash value policies, remember this, will go by a variety of names: whole life, variable life, variable index universal life, final expense, interest sensitive whole life, and just there are some other names out there because a lot of companies just name their cash value products whatever the company wants to name them. But some of the names that I listed on here are just common names that you will hear in the industry. So that is some nuggets about life insurance. And